We're going to continue using the net present value method for these next few examples. We're going to look at two different alternatives for projects, and we're going to look at a total cost approach. We're looking at two different alternatives, and we're trying to decide which one of those is the best option. So we have an example where we have two alternatives. We can remodel our existing car wash, or we can demolish it and install a new one. Our discount rate is 10%, and we have information here of what the projected annual revenues, annual operating costs that give us our annual net cash flow inflows. So the old car wash, we're projecting annual net cash inflows of 45,000, and with the new one of 60,000. If we install a new car wash, it's going to cost $300,000. It will have a useful life of 10 years, a salvage value of $7,000. At 6 years, we will have to replace the brushes, and we're going to get $40,000 for the old equipment that we're removing. So we're going to look at this if we install the new washer. So if we install the new washer, we have the initial investment of $300,000. Then at year 6, we have an outflow of $50,000 when we install the new brushes. For 10 years, we get annual net cash inflows of $60,000. When we remove the old washer, we're going to receive a salvage value of $40,000 for that old equipment. At the end of 10 years, we're going to receive $7,000 salvage for the new equipment. When we take all of those numbers times our present value factors, we come up with a net present value of this project of $83,202. Now let's look at the calculations for remodeling the existing washer. So it will cost us $175,000 to remodel it, and we're still going to have to replace the brushes at the end of 6 years. We are going to have annual net cash inflows of $45,000 for 10 years. So we get a net present value of $56,405. Both projects have a positive net present value. However, removing the old washer and investing in the new washer gives us a higher net present value than remodeling the old washer. So if we have the money available to take on the new washer to pay the $300,000 for the new one, that is the option that we should consider. Next, we're going to look at a replacement of a truck. So revenues are not directly involved, so we're going to choose the alternative that has the least total cost from a present value perspective. So we're trying to decide whether we're going to repair our delivery truck or purchase a new one. If we repair the old truck, it's going to cost us $4,500. Right now, our annual operating costs are $10,000, and its salvage value in 5 years is $250. Its salvage value now is $9,000. If we purchase a new truck, we will have to pay $21,000 to purchase it. It has annual operating costs of $6,000 and a salvage value in 5 years of $3,000. So we're going to look at the two different options. One is to buy the new truck. If we buy the new truck, we have money going out. We have annual operating costs for 5 years. We're going to receive a trade-in value of the old truck. And then in 5 years, we're going to have a salvage value of the new truck. If we keep the old truck and repair it, then we're going to have repair costs. We have higher annual operating costs, and then we have a salvage value. So we can see that buying the new truck is the least expensive option. And that mostly comes from that annual savings and operating costs because the new truck is more efficient than the old truck. So we should purchase the new truck because it's going to save us $9,372 versus repairing our old. We've been assuming that all of the cash flows related to an investment have been guaranteed and consistent, that they're the same every year. Well, we don't always know that about our projects. So what if all of the cash flows related to an investment have been estimated except for its salvage value in 20 years? So we need to determine what the salvage value is. So how large would the salvage value need to be to make this investment attractive? So the net present value that we have to offset is $1,040,000. Our present value factor is 0.104 because we use the discount rate of 12%. So that means the salvage value of this super tanker must be a minimum of $10 million before we could accept this project. When we're ranking investment projects, we try to rank alternatives from the most to the least appealing. When we're just doing screening decisions, we are looking for whether or not some proposed investment is acceptable. So first, we're going to screen them. We get a whole bunch of proposals, and first we're going to screen them to make sure that they meet our minimum requirements for rate of return, payback period, and investment decisions. And then we start ranking them according to preference. The ranking happens under a variety of things. One, money is a limited resource. We don't just have tens of millions of dollars laying around to go invest in new buildings anytime that we want to. So often we will rank them into which one do we pay for first. So which ones may be the most emergent or the thing that we're going to do this year, and which ones are we going to save to do in the future. Most capital budget plans for companies range from 5 to 10-year plans, where we're looking out ahead of time to how much money we have to save in order to pay for these investments and projects that we want to take on in the future, to make sure that we have enough cash available to even invest in these things. One of the ways that we can rank projects is using a profitability index. The higher the profitability index, the more desirable the project. Basically, the higher rate of return it is. So to determine the profitability index, we take the net present value divided by the investment required. That is a very popular way to rank projects. Another way that we can look at projects is the simple rate of return. So the simple rate of return doesn't focus on cash flows. Instead, it focuses on the accounting net operating income. The formula for the simple rate of return, which is sometimes also called the accounting rate of return, is the annual incremental net operating income divided by the initial investment. So the initial investment should be the cost minus salvage value. So when we look at an example, we're going back to that espresso example that we had at the very beginning of the chapter. So we have that cost of $140,000 with a 10-year life. It's going to generate incremental revenues of $100,000 and incremental expenses of $65,000. So our operating income is revenue minus expenses, so $35,000. Take $35,000 divided by the investment. There's no salvage value listed, so it's just the amount of the investment. And our simple rate of return, or accounting rate of return, is 25%. The criticisms of our simple rate of return are, of course, that it ignores the time value of money. We also have that the same project may appear desirable in some years and undesirable in others. When the investment center managers are evaluated using return on investment, a project's simple rate of return may motivate them to bypass investment opportunities that earn net present value. So we saw that in a previous chapter when we're looking at return on investment. We can also use residual income and other ways to evaluate investment decisions in order to make managers make good decisions about projects that have a positive benefit. Now we're going to talk about time value of money calculations and how we come up with those factors that we use. So in the appendix, we have the time value of money. So $1 received today is worth more than $1 received a year from now because we can put it in the bank and earn interest on it. So the calculation for the future value of money is based on the interest rate and how long it's going to be deposited. So we have the future amount, which is the balance at the end of the time period, the amount invested now, the rate of the interest, and the number of periods. So if we put away $100 at an 8% interest for 1 year, then at the end of 1 year, that value is worth $108. What if the $108 is left in the bank for a second year? Then how much is it worth? Well, then the interest that is paid in the second year on the interest earned in the first year is known as compound interest. Because we had $108, we earn a higher rate of interest in the second year. Even though it's an 8% interest, we earn more money on it, $108, than we do on 100. Then in year 3, we would earn more money in that 8% on $116.64 than we would on 8. That's future value. Now we're going to look at present value. So present value is if a bond will pay $100 in 2 years, what is the present value of that investment if I can earn a return of 12% on investment? So the future balance at the end of the period, which is $100, the rate of interest is 12%, and the number of periods is 2 years. And that's going to help us figure out what the present value. So this process is called discounting. When we talked about discounting cash flows throughout the chapter, this is what we're talking about. This means that given a rate of 12% for 2 years, $100 in 2 years is worth $79.72 today. We can also use present value tables. So when we have present value tables, we use a factor. So when we have identical cash flows at the end of each year, we call that an annuity. So if we're trying to calculate the present value of an annuity, we have a tract of land we're going to have a $60,000 payment, which is due each year for the next 5 years. The present value of this stream of cash payments at a discount rate of 12%. So we go to the present value of annuity of 1, and we look for 5 years because that's how long it's good for, and 12%, and we get a factor of 3.605. We take that amount, 60,000 times 3.605, and that tells us the value of 5 cash payments of $60,000 today is $216,300. We have present value of $1 is what we use if we have a different rate every year. The future value of $1 is what the factor table that we can use if we're trying to determine what's the future value of an amount, or the future value of an annuity is the table that we would use if we were trying to determine what is an identical payment that happens at the end of every year. And that is the end of chapter 14.